Stephen, tell us about China's macro 2022 outlook.
Thank you, Paul. So as everyone knows, we have a lockdown in Xi'an, and there may be more lockdowns in other cities if the Omicron virus get out of control. So basically, it's a very bumpy start to the macro economy. On top of that, we will also continue to see more regulatory crackdown, very likely, and then pressuring various developers. We saw Chiu yesterday, and then there's probably going to be more for the year ahead. And also, apart from that, next month we're going to have the Winter Olympics and the 2 meetings in March. So basically, that's somewhat restraining the usual manufacturing output in the beginning of the year. So that's why it's very likely we're going to see more macro slowdown to start off this 2022. Now, last year we saw China's economy slowing down. We saw consumption somewhat softer than expected. Investment, yes, manufacturing investment still remain elevated because of all the high-tech hope for that sector. But then, obviously, property investment is slowing down. And the only upside is really from exports. So exports has been really strong since the pandemic 2 years ago. But this year, there may be some headwind for export as well, just because the global aggregate demand may actually slow as the Fed hikes and also other central banks tightening. Yeah.
So basically what you're saying is it doesn't look good for next year, right? Which is why I think many investors and economists are expecting Beijing to actually loosen monetary and fiscal policy. But I wonder how long will that take to filter through the rest of the economy?
Yes, I think fiscal is probably going to go first, because last year, actually, the fiscal spending, the fiscal stimulus was weaker than expected. Like China didn't really use all of the CGB quota, so they didn't really need that much financing. And if you look at the fiscal deposit data, it's actually higher than usual, meaning that there's still a lot of unused treasury cash in the bank account waiting to be unleashed. And China actually wants the government, local government, to really spend that money to support the economy late last year, and we expect that going to speed up early this year. Now, on local government, they also have 1.46 trillion yuan of special bond quota that they're going to use in the first quarter. So that will give even more spending power for them. So we expect fiscal to do the heavy lifting. Now, on monetary, it's actually quite constrained, just because, as we know, like Fed want to push for a rate hike as soon as March, as Buller has said overnight. So that's why a rate cut is probably out of the question right now. But then there's still chance for another triple out cut. Yeah.